Morrison with NAU Country Insurance, and thanks for tuning in to my first of a series of Thinking Cap videos. I'm going to be recording these short videos from time to time, once, twice, three times a week, and with the idea of sharing some information that I don't get to share with everyone on a daily basis. I get to speak a lot with a lot of people, don't get to talk to everybody all the time, and so this is a great way, I think, to be able to get information out on a particular topic. You can share it with your friends, your neighbors, your customers, whatever the case is. Keep everybody in the loop of what's happening. And so let's dig in right now. And this will be the first of again, a series that we're going to be talking about. Today, I want to focus on what's happening in the marketplace. And the biggest factors in the market today, I think, number one, has been the Brazilian crop weather. Certainly, Brazil, since October has been at the top of the news. Brazil's raising nearly 75% of world soybeans right now, and they continue to, we continue to trade their weather. It was a bullish factor for a couple of months, been bearish for the last couple of months. USDA had a crop report 2 weeks ago, not friendly. Soybeans, corn, all took a hit following that report. China continues to have some major economic woes. Haven't been able to get back on track following a second major outbreak of COVID last year, and they've been struggling to recover. Exports have been down, imports have been down in that country. They've had negative GDPs the last 3 quarters. Not a good deal for us when we're trying to rely on them to get us kind of out of this funk. We've had a very strong US dollar over the last 2 to 3 months. That's not a friendly thing for exports. But finally, what I really wanted to talk most about today was the hedge funds and the impact that they've had on our markets over the last 4 years. And if you rewind, go back to the summer of 2020, when really everything started to happen in our markets. Coming out of COVID, people were trying to figure out, where do we invest? And these hedge funds had a lot of money on the sideline, and they decided, I think, and rightly so, that the first markets to really take off coming out of when our economy reopened were going to be the basics. We're going to be food, fuel, and fiber. People were going to want to go out and eat. They're going to want to drive. They're going to want to go shopping, buy new clothes. And so you saw a lot of this fund money that had been on the sideline look to ag, look to the commodity sector as a place to invest. And you saw what happened from late 2020 all the way into early 2022. We had a magnificent rally in the commodity markets. But over the last couple of years, things not so hot. And why is that? Well, think about it from the perspective of a fund trader. Your job is to make money. You make money by buying low, selling high. And so you started to see, as these markets reached 10-year highs, several of them, you started to see some of these funds say, you know what, it's time to take profits. Let's take this money and go somewhere else. We can make money in interest rate markets now. We can make money in the stock market. And you started to see a lot of this cash go other places. And that's what's happened over the last 2 years. And that shows up really well on this recent chart from Peak Trading. What's happened in the last 2 years just in the ag sector. This chart includes the grains, meat markets, cotton, sugar, coffee, cocoa. And you look 2 years back, these hedge funds were long 800,000 contracts in the ag markets. And at that point, you started to see some kind of shakiness, I think, and a lot of this money started looking elsewhere. And this is a great chart because they show times when the hedge funds were buyers and times when they were sellers. And we've had a lot more red on here the last 2 years than we have green. But you can see over this course of time, they've gone from 800,000 long to, as of last Friday, an estimated close to 560,000 contracts short in the marketplace. I don't think anything shows what happened in commodities more so than this chart right here. And if you look at the breakdown by crops, this is the corn chart. Reuters puts these out occasionally, and this is a great picture. And if you look back at the purple line, back in 2020, this is when everything up and got started. In corn, these hedge funds were basically holding a zero net position in the summer of COVID. And at the time they began to buy, and it also coincided in corn a little bit with the time that China started to buy US corn. But these hedge funds went from zero to 400,000 contracts long in a matter of just a few months. And through all of 2021, through 2022, and even 2023, this red line, as of this time about a year ago, these hedge funds were still long well over 200,000 contracts of corn. But a year ago at this time, two things we talked about. Number one, what do high prices do? They encourage more acres and they discourage demand, especially in the export side of things. And these hedge funds started penciling the numbers like a lot of us were, talking about the potential for a bigger carryover, and they started to dump corn. And they dumped, and they've had a couple of little buying spurts in here based on U.S. weather. But as of last Friday, the black line, now they're short 265,000 contracts of U.S. corn, which is well below what their position was at the summer of COVID. And so, again, if you're a pessimist right now, you would say we've only had two times in history that the funds were shorter. Actually, it was the summer of COVID 2020 as well as in 2019. And then if you're an optimist, you'd say, well, yeah, but they've hardly ever been much shorter than they are right now. And if something positive were to come into the markets, it could totally flip this thing because these people have a ton to buy just to get the position back to zero. So what could cause that to happen? I think number one, of course, would be China. We did see it in soft red winter wheat about a month and a half ago. Could it happen in corn? Maybe, but they've got their own economic issues to deal with there. Number two would be the safrinha corn crop in South America. 78% of the Brazilian corn crop is grown following soybeans. Maybe something happens weather-wise there. The third thing would be U.S. crop conditions, whether it's getting planted, whether it's weather, whatever the case is. All of these, I think, are a bit of a stretch right now. And I think that these funds right at the moment are satisfied with their position. Why wouldn't they be? They've been right. But they're also holding the opposite position of the U.S. farmer, which is holding the biggest stock number in 5 years right now. And I think these hedge funds are betting that farmers at some point here are going to have to sell. Most of us farmers are all hoping that these people buy back and give us a boost in the market. And that's the tug of war that the market's under right now. Same with soybeans. If you look back at what's happened in the beans over the last several years, again, the purple line showing the big buying spurt that they had following COVID. By October, late October, these people were long 240,000 contracts of beans and held that long position for 3 years. And even as of last winter, the red line, they were still long over 180,000 contracts of beans. And even into spring, still long over 120,000. But once that Brazilian record crop started getting harvested last year, these people started to dump and they went all the way to zero. Now we've had a couple of weather driven rallies. We had the weather rally in the United States in the summer. We had the weather rally this fall in Brazil. But once the forecast turned in mid-December, these people have not let off the gas. And as of last Friday, now they're long short 91,000 contracts of soybeans. Again, if you're a pessimist, you'd say really the only time they've been much shorter than this was the record carryout number from 2019 when we had 900 million bushels of bean stocks. We're what, 300 million at most right now. So if you're an optimist, you'd say, these people are so short that if the weather turns in South America or something changes, that they got plenty to buy. Same with wheat. But in wheat, it's a little different because the funds historically have traded wheat from the short side of the market, including all of this year so far. But I would point out the beginning of December when China came to the U.S. market and bought soft red winter wheat for 5 straight days. And when that happened, these people bought back half of that short position. So it can happen. And it gave us an 80-cent rally in the soft red winter wheat market. So will it happen? I don't know. Can it happen? Yes. So again, I think it boils down to, are you a pessimist? Are you an optimist? How long can you hold out? But really, I just wanted to explain, I think it's very obvious why the markets have done what they've done. And it also maybe gives some reasons for a little bit of optimism if you're holding out, because can I outweight these funds? Will they at some point come back in and buy back their short position? And we'll continue to talk about this. Tune into my aftermath webinars each month. We'll continue to update on these positions, update on why. Certainly the balance sheet numbers matter. We'll be looking at those here in the future as well. So I thank you for checking out our Thinking Cap video, first of a series. Hope you like this type of a setup, and we'll be back with more of these as we go forward. Take care. We'll talk to you again very, very soon.